Hi everyone, recording for the 15th of February 2022. So we've completed half the month and we've had quite some volatility around this period. Nice debates going around it on Twitter. Pretty much a firm view that I've held, I think, throughout this time frame at the bottom end of the range. Missing a few of the corrections and for that taken the big bats that people have coming at me anyway. But it's nice. People want to judge you for missing out on a correction and not accolade you for catching the upside. So anyway, that's how the Twitter fights will always be. But yes, managing risk within a range and deciding whether you want to play it as an up-down market or not is primary to being able to do it. Which means that if you decide it's an up-down market, you'll probably take every sell signal as a signal to exit or maybe even short. One of the two decisions. One will be either the exit or the short. But if you take it to be a trending market, you will decide to probably hold on or rebuild positions into the next month or so on, especially if you're trading. So that's I think an important decision part. This is something I've explained in the weekend with Indiacharts as well. Because, once you take that decision, then you sort of capture all the up and down moves. Something that I've been did for years, started off doing, at Sherkhan way back in 2001 based on whatever I'd learned up to that point of time. And for almost a year, every time it moved down, I said it'll bounce back for a retracement, it goes back up and then, you sell into it and then you say it'll fall from here to a new low. That logic works if it's an up-down market where you actually see the market in a downward band and it's like down for a month, then it retraces, then it's down, then it retraces, then it's down. Now, partially you did see that happen, say, between October and November. Okay, that is end of October. So actually I should say November and December. But while that was happening in November and December, part of it I missed because November I was sick and then I was off to a trip to, the Ganges. So I was really not, I was in Banaras, okay, or Varanasi as you might want to call it. And so, but then again, you got the December bounce and then the next two sell-offs after that. So you could have done that for 1.5 months. But the really bigger call for me is, should I go into that mode? And not just for 1.5 months, because what I'm talking about is what you saw between 2015 to 2016 for an entire year. And each of those legs were like one month long, so an entire 5-wave decline, then an entire retracement, not just smaller ABC, retrace ABC. So I was not expecting that kind of a market, like a 1 year corrective phase. And that is why I did not change my strategy from being long only or, long exit to doing a long short. Okay, so which is partly why you miss out on those. I had written, in fact, a long short strategy in March when we actually started the weekend with Indiacharts shows. That's the first time you got a slightly up-down market, very narrow range, but an up-down market from the first week of March into the first week of April. And so I wrote something called Guerrilla strategy, which is essentially this, that once you decide you want to do an up-down market, we know how to play it. I've done it many times. But you have to take the decision that it's going to be an up-down market and that I'm going to, run every time it gets up there. And that has not been my primary view. It still is not. Broadly, on a 2-3 month basis, I think what we've actually done is fallen from, 18,600 down to 16,410, then gone back to 18,300, fallen back to 16,800. And now we are back at 17,600, 17,000 and struggling in this very minor 600 point range now. But we are at the bottom end of this broad range that we've had for 3 months. So it's no more downward slanting. It's in fact more sideways. Now within this sideways, you can keep saying, okay, will we go back to 18,000 and come right back to 17,000? My sense is that at some point of time, that's not going to be the case. We're going to break this range. And so I'd rather be prepared for breaking the range. And then you need to decide where is the risk reward. So if breaking this range for you is the short side, then you're better off shorting at the top end of the range. If you're a bull or you think this is a bull market and it's not over, then you probably think of the bottom end of the range. And right now, as you get closer to 17,000, I see ourselves at the bottom end of the range. Now, so that's, I think, been broadly the view. Okay, and so I've stuck to that. And like I said in one of the WWIC things, I said, Fatti to meri bhi hai. I know this is not an Hindi video, but then I have to throw that in because no matter who you are, no matter what trader you are, investor you are, you are going to face a situation where the wall is against you, and you yourself are going to be, worried and tense. Okay. But the only thing you have depending on is that you have a methodology that allows you to stay the course. Okay. So it finally comes down to your method and process. Okay. You're going to face the same problems. I'm going to face the same stress that everybody else does with a position. Okay. Or with the idea that they want to capture the top or the bottom. And then how do you do that? Like today, if it bounced for 500 points, there are two things to it. If I say that, okay, let it close positive and then we'll take a view that, it's good. You say, oh shit, it's already up 500 points. How the heck do I buy? And then second is, should I have done some buying yesterday in some position sizing? And so if I had already had some position yesterday, it would have been so much more easier for me to add some more today. Not just because of spreading out the money and the lower risk in having an additional position already in existence, but when you have a position and it goes in your favor, it's much more easier to add. And when you don't have a position, or even worse, if you're actually trading the short side thinking it's the bigger one and then it falls, you'll not be able to buy the bounce. Okay, maybe you would never buy the bottom. You may have cut your shorts also. Let's say you're smart enough, you cut the shorts. The moment it bounces back, would you be able to buy over here at the close? Okay. So this was a very important behavioral aspect to get over. I know that once you take a bearish mindset, now if I think that this is a downward market, downward slanting market, 1 year corrective phase will make lower lows and lower highs. In 1 year, you may be down 20% and then the bull market will resume. Provided, and that view goes wrong. Okay, so let's presume if that view is right, fine, great. Every time the market bounces, I short. But what if that view goes wrong? Which means that we start a rally from here and goes to 19,000. You will not be able to participate. Okay. And then you'll wonder whether it was greater to have captured the few days of fall, because falls of course come much more faster and sharp within, like it can take 2 weeks to go all the way to 18,300. And in 6 days last month, we fell back. Okay. Now that was the steepest retracement in the last 1 year. We haven't seen an 80% retracement of any rally in the last year. So which is another reason why I didn't expect it. I thought that 38% good enough. Moving averages maybe closer to 50%. Okay. And then it became 80. And that all of that from 50 to 80 was in 1 day. So when it happens in one particular day, okay, so it's a very short period of time. Whereas you're trying to ride something which is a position. Okay, so they're completely two different aspects. One is a very short time horizon. Okay, it's almost down to being a day trader at times. Like for example, the Russian news over the weekend, Monday gaps down hundreds of points, panics all the way to the bottom, and today you're completely reversed. So are you really playing for that 1 day trade, or can you actually see that as a part of a trend? Okay. Now, what do I mean? Even if I go back to 2015 or 2012, I remember the market was falling. I was bearish. It fell for 6-7 days. And then there was actually bad news. It gapped down. The gap ended up being what we call as is what we call a measuring gap for people who studied gaps. A measuring gap essentially occurs midway into an entire move. So when it occurs midway, what you end up getting is an equally sized move below the gap. So that time when a gap occurred, I sat on to that short position and continued to fall for several more days before I then exited, and it even fell after I exited. So you cannot really catch the bottom, but broadly speaking, you know what is going on. The point is that when you're in a broader downward trend, the negative news aids your downward trend and helps it to continue. But when you're in a broader upward trend, the negative news ends up being a 1 day gap down exercise and you end up going wrong. Okay. And I've done that as well. Okay. So I've done that short side, gone wrong, and then seen it gap up and run away, and then realized that, oh shit, what the heck was that? And it actually happened on Brexit. So let me admit it. I thought around Brexit that maybe it will top out, and then there was an ending diagonal on the chart, and so we bought puts, and next day it went down, fell great. By the end of the day, it was already recovering, and next day it was running away again. And the reason these things happen is many times they get discounted by months and weeks of activity. Okay. So the news, if it was a shock, it would have a different impact. But knowing that it would be a shock, the news was floated around for almost 12 months prior to that, oh, we might have to do this. What will be the impact? Won't do it, will do it, won't do it, will do it. Someone will have to vote to it. Parliament will vote on it. And by the time it actually happened 1 year down the line, I think markets had sort of digested the impact of that. This is also similar to the kind of policy that we are getting from central banks right now. So what central banks are really doing is that they're using communication as a tool, right? So when they're using communication as a tool, what they're really trying to do is tell the markets that, see, this is what we plan to do, okay, and this is the intended outcome, and this is why we want to do it. Okay, so they're sort of giving multiple communication points. They're telling the inflationists, boss, don't inflate too much or we'll be forced to raise rates. Okay, so they want your inflation expectations to come down. At the same time, they're saying we'll raise rates, to bring down inflation, and so people but the bond market starts anticipating much higher rate hikes. And in the background, you know that the debt levels are so high that if they do these rate hikes, the world falls apart. So which means either they want the world to fall apart, and if that's not their intention, they're not going to raise rates that much. I mean, they might do it a few times, as a sign that, yeah, they want to do it, just to show that they have intentions. But there's a limit to what they can do. And the moment those intentions hit a wall, which is that, there's too much market reaction to it, they might have to turn back again. So there's this back and forth on rates that is going to happen in the coming years. I think a lot of people the smart money is already anticipating that. The hard part is going to be timing those ins and outs. Okay, at what point are they going to turn? And because markets are anticipatory in nature, and because central banks are giving you these clues months in advance, the market is ending up discounting the whole damn thing. Which means, if you go back and read the news, from March of last year, I've been hearing rates are going up, inflation is rising, rates are going up. So for almost 9 months, we are hearing about bond yields going up. But the markets continue to rise. But where would it get discounted? The dollar. So the dollar did a huge counter trend bounce, retracing 50% or more of its losses in 2020 in 2021. That counter trend move has already discounted the potential that there will be a couple of rate hikes. In fact, the bond market itself has already discounted 4 to 5 rate hikes. Okay, so it's already ahead of the curve. Now the reverse way of saying it is, the Fed is behind the curve. But the Fed has been transmitting this policy. They've been saying it orally. So in a sense, what they have done is they've already pushed the bond market to a point where it's oversold. The weekly RSI of the 10-year bond yield that I've published today is at 25. The daily sentiment index has not reached single digits like it did at the previous low, from where it bounced a little and then fell again. But we can get there. If yields rise a little more, I think you can easily get to single digits. But they don't always, every bottom doesn't have an extreme reading. But then again, if that is true, we might still have some yield spike left in the market before that happens. But we've already seen that in the dollar. We've seen extreme sentiment in the dollar. We've seen the dollar roll over. So these things have already happened in anticipation, and if you start extrapolating these trends that nahi, ye to chalta hi rahega, dollar will keep rising and the world will come to an end, bond market will keep falling because the Fed is going to do this. What you're overlooking is that the Fed has already transmitted that policy into the financial markets and it's already discounted. So that's where the war is between the bulls and bears as to whether it's discounted or not. Okay, I'm with the view that it's discounted because I have a larger view, which also fits with I'm able to discount it using the Elliott wave model. So the Elliott wave model is a behavioral study. Okay, so it's sort of testing the behavior of everybody who's participating in the market put together. And so that's the judgment we try to take on different levels. One on the macro factors. So we have a view on the macro factors, which is the dollar, the bond market, and so on. Then we have a view based on that on the underlying, which is commodities, inflation, and then equities. And then we also studying sentiment, because sentiment is a part of the behavioral science. And then we are matching how the fundamental data is flowing in and how does it match with what the behavioral model is telling us. So at times the two are in conjunction, that two are saying the same thing, and then there's a trend. And then one of them breaks away. You reach an extreme, it becomes oversold or it becomes overbought. It looks like now this parameter is not going to move. But the fundamental news continues to move in that direction because it tends to overshoot. People tend to over-expect something. Just like guys, are starting to say, no, 5 rate hikes, 7 rate hikes, 10 rate hikes. I mean, what's wrong with you? The Fed hasn't even done one. Forget doing one. They have said we haven't even started talking about raising rates. Then he was asked in the last meeting, no, but then how are you going to decide whether you'll raise? We haven't even started to discuss what are the parameters on which we are going to do this. So essentially you are saying this has not even come to our table. We haven't even started the discussion on it. And everybody wants to know what they're going to do, and they're already predicting what they'll do 1 year down the line. So that's how bizarre markets are going in terms of over-expecting and overshooting on one side. And so what ends up happening is by the time they even do one baby step, the underlying markets, because they've over-discounted it, start turning and going the other way. And that is what I'm starting to anticipate is going to happen in financial markets. Now, the only fear in between of all of that thought process that I was building on last week in my Hindi videos, I've explained this as well, is Russia came along. Now, there's a geopolitical angle. Most of us as market experts are not geopolitical experts. And so, on Sunday and Monday, I really had no idea how to think about it, but I'd completely forgotten the socioeconomic angle. And so I ended up writing that post and sharing it where, in fact, we'd already written, 10 days ago, Jay Vora, who's my market analyst on the team, had written a post on Russia saying, sir, ABC to ho gaya. And I said, yeah, that's what even I think. And it's a fourth wave on the monthly chart. But what I thought in my post is that if it's a zigzag, maybe it's not a fourth wave, it's still a second wave of a higher degree. And in either case, that wave was complete, the corrective, because zigzag means an ABC correction where C and A are either equal or C can extend, but C had achieved that equality and it had already reversed. And it is close to breaking out of the falling channel. Okay, so that hadn't happened, but we were there. And so, moment I see that, I feel that, well, Russian stock market is going to go up and the whole world is panicking about Russia attacking Ukraine. I mean, if India was attacking Pakistan and we were due for a war and there were lakhs of soldiers on the borderline, you think the Nifty would be the one going up and the rest of the world would be going down. I mean, what kind of sense does that make? So that was the simple logic on which on Monday then, in fact, I should thank Prashant. He forced me to think about it on Sunday. He said, what should we do on this thing? Should we have a discussion on this? And I said, the only topic over the weekend are two. One is Russia and one is RBI. And then I actually started doing R&D on Russia because I had no idea what to say on Russia. And then I actually got this. Then I looked into it and I saw that, well, their market's fallen not just from October. We've already called the bottom on our blog. And it actually started rising. And to add to it, the reason it fell from October to then was they were actually, I tried to put the pandemic angle to it because they had huge cases. The cases were not coming down. I remember seeing that a month or two ago. And now with the Omicron jump, which every country has seen, now they are seeing a huge surge in cases. So that could be the economic overlay. And so despite rising oil prices, which should have been beneficial, Russian stocks should have done well, but they actually come down. It's similar to what, say, Brazil faced. They raised rates, they tightened the economy in the face of, rising prices and inflation. And now they're actually trying to reflate again. And so they're in a different zone. So they've seen a deep correction and bounce. You're seeing the same thing in Russia. I know people listening to this will say, yeah, so why not India? Because the fact is we are not doing that. We are not doing what Brazil did. We are not raising rates in the face of inflation, not yet. If inflation goes out of control, maybe we will. But we haven't gotten there and the RBI is saying that it's transitory. So, not in the same language, but I guess they're saying the same thing because if they say that inflation will come back to 4.5% 1 year down the line, they're going to be patient. And he said that he doesn't want to shock the market. And last not the least, they want to support growth, right? So if they've had the growth momentum where the GDPs come back to where it was pre-pandemic, how do you go forward from here? Don't you want growth forward from here? So they've got to support it unless you think that there's enough energy for it to keep going on its own. And that wouldn't be true because none of the other countries, including ours, while we've stimulated our economy by some amount, we haven't done it in USA style, right? Nobody's done it in US style. And so we don't have that kind of firepower going under the market that we can say that, okay, it's gone, it's getting overheated, let's slow it down. We've just managed to get back where we were and we need to actually move forward from here. So we are all in a different boat. So in that sense, I feel whatever the RBI did is pretty much right and pretty much good. It's forward thinking and trying to overlook the near-term inflation problem. In fact, I think even the US was doing that and would have done it if they did not have a major election issue. We also have one, but we don't have the inflation problem at the same degree. So because of that, there's pressure to really announce, a hawkish view and an attempt to bring down prices when everything about a Russia-Ukraine standoff is really pushing oil prices higher, right? So that's why it was not making sense. Another reason, it was completely not making sense. We would have had inflation jumping again if oil went to $150 because of some war around that region and capturing Ukraine, one pipeline. I don't know. I'm going into geopolitics, like I said, not my study area. So I really went into the other one. I ended up doing the socioeconomic study and studying the Gulf War and seeing the pattern and then seeing what our Elliott wave view was on Russia. And that gave a completely different picture. If things had to turn bad, they usually do at the start of wave C or by the end of wave C. For example, before the Y2K bear market was over, 9/11 had happened, and US had already attacked Iraq, right? So that's the point. So if it hasn't happened yet, it's not going to happen. And I know that's a completely opposite view to what EW has said, that they will go in, but my view is that they won't, because wave C is already over. If they had to go in, they should have already. So somewhat differing, even though everything I know about socionomics and a lot of these learnings about, war occurs in wave C and all are all part of Rector's book. So every Elliottian has learned Elliott wave analysis from his book, socionomics from his work. So we completely, thank him for doing that work. But as analysts, we can all differ, right? Because each analyst has his own opinion. And so that is where I've managed to differ on that. So yeah, that's where we are. We thought Russia was overdone and was signature of a bottom. And so once again, we ended up getting a panic low, at least as long as we are hearing troops are withdrawing. But that's just, we don't know if it's a full-blown withdrawal or it's just, okay, some are going back. But let's see as the news develops. If there's any other negative news, you'll still get some shocks in the market. But I do think from a pure sentimental perspective, we did reach an oversold condition. So that there is no doubt. My own proprietary swing indicator, which I publish every day, had gotten there. It was 5 yesterday after yesterday's sell-off. So even today morning, if you use that as a sign and use the momentum indicator on, say, an hourly chart to start, taking some entries, one would have actually been able to benefit from that. Where do you get the momentum indicator? You download Trade Tiger from Sher Khan and it's available there. So we've made that available on at least that one platform. And so that's where you get it right now. But the swing, of course, is published in our Indiacharts Insiders Nifty daily products. If you want to refer to it every day, that is where we publish it. And we have to manually calculate it. So that's an indicator we cannot really program. So having said that, there was one more data point I mentioned on the update that the spaces we did with CNBC Prashant Nair last weekend. And I mentioned at that time that FIIs had reached the maximum short position since the start of all this. 30th March 2020, they were 65,000 contracts short. In March itself, they had a peak short of around 167,000, which they had reduced by the end of the month. And now, at the end of January, before the budget, they were 65,000 contracts short. So that is now reduced. It's almost zero, plus or minus 5,000-6,000 contracts is what we have seen in the last 3-4 days. So that's not much. But yeah, when you reach that kind of an extreme, which is a max short position, what it signals is that possibly they've done most of what they wanted to do in terms of their selling. That is how I read it. I take it as a contrarian indicator. And that's what I thought then, even though we rallied after that, after the budget, but then we sold off again back to the same levels. And I'm happy at least that level is held, because prior to the budget, we made a low of 16,830. Yesterday also, we've tested that 16,809, few points, which is not much. And why I'm saying 16,830 is it's a 78% retracement of the January rally. So we've held that low, made a double bottom there and bounced back today. Hopefully it marks the start of the up move that I've been anticipating. And of course, we'll know that only following ahead. But I always like to be there where the risk reward is best. So you can always figure out tomorrow we are wrong. But the question is, where did you buy, before you're wrong? So if you bought early, you're not wrong, right? You can always get out at some point of time. If you waited 2,000 points before confirming that, yes, this was a rally and then bought, of course. So people come and say, oh, you're wrong from 1830. But we were bullish at 17,000. So it went from 17,000 to 18,300. And then it starts to fall and in 6 days comes back to 17,000. Okay. But did you capture that rise and did you make anything on it? Did you have an exit strategy? So that completely takes you into an execution mode. It is nothing about having a view. It's about execution. And like I stated in the beginning, to be on the right side of the bigger moves, you have to decide upfront, what is the bigger move? What do you want to play? Where do you want to participate? And for most people, it also involves getting over the behavioral aspect, which means, will I be able to stay long if I go short? Okay, so if it's an up-down market and you want to play long short, if you're able to predict this is going to be a 1-year up-down market, then fine. Then I'll also change my strategy and do a long short. But right now, I do not think so. We are doing anything like 2015 or 2011. And therefore, I did not change my style, which is why I will appear to be wrong on every correction. because I'm not calling it a top, and I will appear to be right on every time it goes up, and that's simply going to go on till one of the camps is proven right. I think that's how I'll take it. But I know which camp I'm in, and there's no change in that view despite all the recent volatility. And by tonight, I think you should get the outcome of the 2-day meet that is happening with the Fed. Too many people just expecting that they'll do a rate hike now only, not even wait for the next meeting, when they've said that we haven't even started discussing what we want to do and how we want to do it. You expect them to come out today, which is not even a rate setting meeting, to announce something like that. So unless it was an urgency, I don't think they're going to be doing anything. But if they do make some statements which sort of, reduce the hawkishness of the Fed from earlier views, that would probably help markets in a way. And then if they even don't say anything again, markets will say, fine, it's not happening now. Two different levels of discounting. But I'll leave you with one last thought that I've been thinking of, highlighting, probably said it in many different ways, and seen this whole debate around inflation. And I think I mentioned it again in the last spaces, was what are you calling this, inflation or reflation? Okay, very important distinction, because inflation means prices go up at the cost of someone else, is what I mentioned there. And cost of someone else means that prices of, say all your consumption goods go up, but your income does not. Okay, or your input costs go up, but you're not able to pass it on. Yes, that's a serious problem. And that is why the term stagflation was probably introduced. But as we have read history books of economics, stagflation is rare. There are no examples of it except the 70s. And probably one rare example, maybe at all, if at all, 100, 200 years ago, or I don't know if it is there or not. And so when you have something which is so rare, then what is stagflation really, except for our expectation that growth and inflation cannot coexist. When most of the time inflation is an outcome of an overheating because of either growth or monetary policy. One of the two, right? It's a monetary phenomenon, it's a growth phenomenon. You had excessive growth, overheating, and it leads to inflation. But inflation as a sidekick, okay, has always been the precursor of stock market rallies. So you get growth and then you get some moderate inflation side by side, which means your nominal GDP growth goes at a higher rate. It leads to better government revenues and everything looks rosy. So what's so bad about it? Except when it becomes a political issue, if inflation is so high that people start complaining. So that's essentially the main reason to be bothered about inflation. And now with a much more educated, class of working class, I should say, people who know that investing is a means of beating inflation. I mean, that's how it was sold, right? How a mutual fund sold originally to everybody. Buy a mutual fund, invest in equities, and it's your best hedge against inflation because fixed deposits do not beat inflation. Isn't that the story? I mean, unless I have the story wrong, if that is the story, aren't you supposed to be long equities to beat inflation? Equities have always been the best way of beating inflation. While some people might say, no, it's gold. But gold in a moment when equities are not doing well, and you get a currency devaluation, then it's the best hedge against your currency. But if that's not the scenario, okay, and in a free floating rate environment, when you get growth, you actually get a strong currency, especially where dollars are flowing around the world. If your economy is doing well and you're attracting FII money or FDI money, your currency gets strong even though there is some inflation. So currency is not going to help you on gold side. And what really helps you then is equity. So equity ends up being the best performing asset in a lot of studies also, where equities, gold and real estate have done well. Equities comes on top, actually speaking. If I'm wrong, correct me. But in either case, if equities do well in an inflationary environment, and if you get growth plus inflation, it is doubly good for equities. And what are we all complaining about? Unless you say that next year earnings growth is not happening. Okay, or the GDP growth is not going to be at 8-9%. And I would have agreed if government was not spending that the growth will not work out, which was my view between 2012, 2015, published and free to read at Indiacharts.com. So having said that, to all the critics who haven't read all those previous views, the big change in stance has been that unlike my economic winter reports where I said that I'll change my winter view if the government starts spending, well, the government is spending now more than they did before, even as they're keeping fiscal tight. And so that's the good news. And if they're able to raise more money and spend more, if we get that, think of it as a continuous spiral. It just started last year thanks to the pandemic. We got this kind of motion in place. Now, if we can keep this motion going, we got a very good tax revenue outlook this year. Will it continue next year? Let's hope so. Let's keep, if that, wheel keeps staying in motion, then we've got it. We've got a bull market. And that, I think, is what we need to be really monitoring and watching out for. Bear markets will not happen just like that. Okay. And should you get that 20-30% type 1 year decline? It's a possibility. All bull markets get corrections, but this bull market itself was so different in its nature and behavior between sectors and stocks that it didn't happen, which is why you don't want to anticipate it early unless you're definitely sure. I'm not. Okay, so I'm not anticipating it, and I will try to, but only when I'm very sure. So that's all in this update from me. If you're betting on inflation being high or structural or remaining consistent or coming down a bit and going up, there's one place that's going to beat it, and that is equities. Thank you.